Did you know that over 4.7 million Australians could lose access to vital payments, pensions, or benefits because of new rules taking effect in 2026? That's not a prediction, it's already locked in. From subtle changes in superannuation to sweeping Centrelink updates, these reforms will quietly reshape the financial future of everyday people, and most have no idea it's coming. The government says these changes are for the better, to modernize, streamline, and reward smarter financial choices. But here's the twist. If you're not prepared, you could lose thousands of dollars, miss out on benefits you're entitled to, or even find yourself cut off from essential support. These aren't just policy tweaks, they're life-altering shifts hiding in plain sight. So in this video, we're breaking down the 10 biggest financial rule changes set to hit Australians in 2026 and what you need to do right now to stay protected. Number 1. Pension Asset and Income Test Changes. From January 2026, the Australian government is making major adjustments to how the age pension asset and income tests work, and these quiet changes could dramatically alter your retirement plans. While they might seem minor on paper, the real-world impact could mean the difference between receiving a full pension, a part pension, or no pension at all. These new thresholds will affect how your savings, property, and even personal possessions are assessed when applying for government support. Here's what it means in simple terms. If you've got assets like a second property, investments, or even a decent amount of money in the bank, you may now fall outside the new eligibility limits. Even small increases in your savings or super could push you above the threshold, meaning you receive less financial support or nothing at all. On the flip side, if your assets are under the revised limits, you could be entitled to more than before. It's a double-edged sword, and not everyone will land on the right side of the blade. So what should you do? Start by reviewing your financial position today, especially your super balance, investment properties, and other assets. A small restructure or shift in ownership could help keep you under the limits and eligible for full support. And don't assume you're safe just because you're already receiving payments. These changes apply to existing recipients too. Ignoring these updates could cost you thousands per year. Think of it like this. If you don't adjust now, the rules might adjust you out of the system.
Number 2. Payday Super is coming. From July 1, 2026, one of the biggest shakeups to the Australian superannuation system in decades will begin, and it's called Payday Super. For the first time, employers will be legally required to pay superannuation at the same time as your regular wages. That means no more waiting months for your super to be deposited. While this might sound like a win, and for many it is, it also introduces new risks and responsibilities that could catch millions off guard. Currently, employers have until the end of each quarter to pay super contributions, giving them flexibility and, unfortunately, creating room for late or missed payments. But with Payday Super, every paycheck must include your super, instantly boosting transparency. For workers, this is a game changer. Your retirement savings grow faster, and it's easier to track what you're owed. But for small businesses and casual workers, it could cause cash flow issues and administrative headaches. And if employers miss these new deadlines, it's not just unfair, it's illegal, with tougher penalties coming into play. For employees, the key takeaway is simple. You need to start checking your payslips. Make sure your super is being paid correctly, on time, and in full. If you're a freelancer, contractor, or part-time worker, now's the time to clarify your super entitlements with your employer. And for business owners, the pressure is on to update payroll systems and budgeting processes before the deadline hits. Payday Super might sound like a back-end policy change, but in reality, it's a shift that will affect how and when millions of Australians build their retirement wealth, and whether they're left behind in the process.
Number 3. Super contribution caps are increasing. In 2026, the Australian government is set to increase the caps on superannuation contributions, which sounds like a positive change, and it is, but only if you know how to take advantage of it. These caps refer to how much money you can voluntarily put into your super account each year, either before tax, concessional,
or after-tax, non-concessional. With the new rules, you'll be able to contribute more without triggering extra taxes, giving you a powerful opportunity to grow your retirement savings faster. However, there's a catch. If you don't make use of the higher caps, you miss out. These contributions aren't carried over unless you meet strict conditions, and if you exceed the new limits without proper planning, you could be hit with extra tax penalties that reduce the benefit entirely. That's why understanding these caps is essential. Whether you're approaching retirement or just starting to focus on long-term savings, this change gives you the chance to build a bigger safety net, but only if you act strategically. To make the most of it, sit down with a financial planner or review your super account yourself. Consider salary sacrificing more of your income, or if you've had irregular work patterns in recent years, look into the carry-forward rule to make up for past low contributions. The bottom line, this rule change is an opportunity disguised as a deadline. Fail to act and you'll leave money on the table. But if you prepare ahead of time, you can use these increased caps to secure a more comfortable retirement and take control of your financial future before the window of opportunity closes.
Number 4. New tax rules for high super balances. Starting in 2026, Australians with superannuation balances over $3 million will be hit with a new tax rule that could significantly reduce their long-term wealth. This new legislation introduces an extra 15% tax on earnings related to the portion of your super that exceeds the $3 million threshold. That's on top of the existing 15% tax on most super earnings. While it only targets a small percentage of people, its ripple effects could influence how many Australians plan, invest, and save for retirement, especially those nearing that balance limit. The key issue here is that the tax applies to unrealized earnings, meaning you can be taxed on paper gains, even if you haven't actually sold any assets. So if your investments increase in value due to market growth, you could be taxed on that growth regardless of whether you've withdrawn any money. This is a major departure from how most taxes work in Australia, and it has raised concerns among financial experts about fairness and practicality. For those approaching the limit, this rule could create significant planning challenges. What can you do? If your super balance is nearing or expected to exceed $3 million, it's time to reassess your strategy. Consider options like diversifying outside of super, using family trusts, or adjusting investment risk to avoid being unfairly penalized by unrealized gains. Even if this doesn't affect you yet, staying informed is critical, because limits like this often change over time, and today's thresholds could be tomorrow's new normal. This rule marks a shift in how the government treats wealth inside super, and ignoring it could cost you far more than just extra tax. It could mean a complete overhaul of your retirement plan.
Number 5. Centrelink payment rules are changing. In 2026, sweeping updates to Centrelink payments will come into effect, impacting millions of Australians who rely on government support. From youth allowance and disability support pension to parenting payments and job seeker, the government is revising eligibility criteria, income thresholds, and reporting methods. While some people will receive more, others could lose access entirely, often without warning. The goal, according to officials, is to streamline the welfare system, but the reality is that these updates will disrupt the financial stability of many vulnerable households. One of the biggest changes is how partner income affects your eligibility. If your partner earns above a certain threshold, your payments could be reduced or canceled, even if you personally have no income. For couples, this means that one person's financial progress could accidentally disqualify the other. In addition, there will be tighter reporting systems, requiring recipients to update their circumstances more frequently and with greater accuracy. This means that even small changes in income, living arrangements, or savings can now trigger immediate changes in payment levels or lead to debt recovery demands. If you or someone in your household receives Centrelink support, the time to prepare is now. You need to understand exactly how these rules will apply to your situation and make sure you're not caught off guard by sudden cuts or reporting issues.
Keep your records up to date, check your eligibility regularly, and consider seeking advice from a social worker or financial counselor. These updates are not just routine adjustments, they represent a fundamental shift in how Australia supports its citizens, and staying passive could result in missed payments, mounting debt, or being wrongly cut off. It's not just a change in the system, it's a change in how the system sees you. If this is opening your eyes to changes you didn't even know were coming, drop a comment and tell us how this might affect you. We'd love to hear your story. And if you appreciate the deep research behind this video, support us with a quick subscribe. It's just one click, but it means everything to us.
Number 6. Higher income limits for working pensioners. From 2026, older Australians who choose to keep working while receiving the age pension will be able to earn more income without losing their benefits, a shift that could open new financial opportunities for retirees across the country. The government is lifting the income-free threshold, which is the amount you can earn before your pension starts to reduce. This change is designed to encourage older people to stay in the workforce longer, easing pressure on the economy while helping pensioners maintain a higher standard of living. Under the new rules, you'll be able to earn thousands more each year through part-time or casual work before your pension is affected. This means you can take on extra shifts, seasonal jobs, or freelance gigs without being immediately penalized. For many retirees, especially those who still want to stay active and socially connected, this provides a way to boost their income, pay down debts faster, or even top up their super without dipping into savings. But there's a hidden side. If you don't report your income accurately or misunderstand the limits, you could still face Centrelink debt notices or overpayments. To take full advantage of this change, you need to plan ahead. Understand exactly how much you're allowed to earn and keep detailed records of any income you receive. Even informal or irregular income, like cash jobs or hobby earnings, could affect your entitlements if not declared properly. Consider speaking to a financial advisor who specializes in retirement income so you're not caught off guard. This update is more than just a policy tweak. It's a chance for older Australians to gain greater financial independence as long as they navigate the system carefully and stay within the new rules.
Number 7. Medicare and PBS changes. In 2026, the Australian government is introducing key updates to the Medicare safety net and the Pharmaceutical Benefits Scheme, PBS, which could significantly affect how much you spend on healthcare. On one hand, some essential medicines will become cheaper, and access to bulk billing will improve for low-income families and pensioners. On the other hand, changes to safety net thresholds mean some people will need to spend more out of pocket before they qualify for higher Medicare rebates. It's a shift that could either relieve financial pressure or increase it, depending on your circumstances. These changes are designed to target help toward those who need it most, but they come with complexity. For example, if you're managing a chronic illness or require regular prescriptions, you may benefit from expanded PBS coverage. However, if you're just above the income eligibility line, you might now fall outside the bulk billing safety net and see your medical expenses rise sharply. With rising costs of living already stretching household budgets, even small increases in healthcare spending can have a major impact, especially for families, carers, and the elderly. To stay ahead of these changes, take time to review your current Medicare entitlements and check if your medications are affected by the new PBS pricing. Talk to your pharmacist or GP to understand how these rules may apply to you. Also, consider tracking your out-of-pocket costs throughout the year so you're aware when you hit safety net thresholds. For many Australians, healthcare is one of the biggest ongoing expenses, and these changes, while well-intentioned, could leave some people paying more than ever before if they don't stay informed. Being proactive now could save you hundreds or even thousands over the course of the year. Number 8. New rules around cash usage. In 2026, Australia is moving closer to becoming a cashless society, with new laws being rolled out that will impact how and where cash can be used. While physical currency isn't being banned outright, certain businesses will now be required to accept cash, while others may legally choose to go completely digital.
These rules aim to balance consumer choice with modern payment systems, but they're also creating confusion, especially among older Australians, regional communities, and small businesses who still rely heavily on cash for daily transactions. One major change is the introduction of mandatory cash acceptance for essential services, like pharmacies and utilities. This ensures people without digital access aren't excluded. However, other businesses, including many in retail and hospitality, may be allowed to continue going cashless. For customers, this could mean inconsistent experiences, where some places accept only cards, others insist on cash, and some offer both. And for businesses, especially smaller ones, there's now pressure to upgrade payment systems, comply with new laws, and navigate rising merchant fees from card providers. If you're someone who prefers or depends on cash, it's time to pay close attention to where and how you can still use it. Keep an emergency amount on hand, but be prepared for more businesses to refuse it. And if you run a business, check the specific rules that apply to your sector. Failure to comply could result in fines or customer backlash. This isn't just about how we pay, it's about access, privacy, and control. Whether you see it as progress or a problem, one thing is clear: the role of cash in Australia is changing fast, and those who don't adapt could find themselves left behind, both financially and socially.
Number 9. Mid-year income tax cuts. From July 1st, 2026, new personal income tax cuts will come into effect across Australia. And while this might sound like good news, the reality is more complex. These cuts are part of the government's long-term tax reform plan, aimed at simplifying the system and offering relief to middle-income earners. However, the savings won't be equal for everyone. In fact, some lower-income workers may see very little difference, while higher earners could benefit the most. The real question is, will your take-home pay actually increase in a way that matters? Under the new system, marginal tax rates are being restructured, and some tax brackets will shift entirely. This means the way your income is taxed could change, even if your salary stays the same. For many Australians, this will result in a few extra hundred to a few $1,000s per year in their pockets. But without a clear understanding of how the cuts apply to your specific income level, you could be caught off guard. The changes may also affect your HECS repayments, family tax benefits, or other government support, depending on your adjusted income. To make the most of these tax cuts, now is the time to look closely at your income and review your budget or salary packaging options. If you're a sole trader or run a small business, speak with your accountant to understand how these cuts impact your taxable income and what you can do to maximize benefits. While the headlines focus on tax relief, the finer details tell a different story, and not everyone will come out ahead. These changes may seem subtle, but they could have a lasting effect on how much you earn, how much you save, and how your financial future unfolds.
Number 10. Digital reporting for Centrelink and aged pension. In 2026, the Australian government will roll out mandatory digital reporting systems for Centrelink and aged pension recipients, marking a major shift in how income, assets, and personal details must be declared. This move is designed to improve efficiency, reduce fraud, and ensure faster processing, but it also places more responsibility on individuals to report accurately and consistently through digital platforms. For many, especially older Australians or those without reliable internet access, this change could cause stress, confusion, and even unintentional penalties. The key change is that most reporting, including income updates, changes to living arrangements, and other eligibility-related details, will now need to be submitted online through MyGov or Centrelink's digital apps. Paper forms and over-the-phone updates will be significantly reduced or phased out altogether. While younger or tech-savvy recipients may find this convenient, others may struggle to keep up, especially if they have limited digital literacy, language barriers, or accessibility challenges. Missing a single report or failing to update a detail correctly could result in suspensions, delays, or overpayment debts. If you or someone you care for receives Centrelink or pension payments, it's essential to start preparing now. Set up and verify your MyGov account, learn how to navigate the system, and consider seeking help from community centers or support services that offer digital training. You should also regularly check your details to ensure everything is up to date and avoid unexpected disruptions. This digital transformation isn't optional. It's becoming the new normal. While it promises to modernize the system, it also creates a serious risk for those who aren't ready. Taking steps now could be the difference between staying supported and being cut off when these rules take full effect.
As we've seen, the financial landscape in Australia is about to shift in some serious ways. From changes to super contributions and pension eligibility to new tax rules and digital reporting requirements, 2026 won't just be another year. It could be a turning point for your financial security. These aren't just dry policy updates buried in government websites. These changes affect how much money you'll take home, how much support you'll receive, and how confidently you'll be able to plan for the future. The most dangerous thing you can do right now is assume that none of this applies to you. The truth is, these rule changes touch almost every age group, whether you're working, studying, raising a family, retired, or running a business. What's being introduced in 2026 isn't just a list of reforms, it's a complete redefinition of who qualifies for support, who pays more, and who gets left behind. And if you're not prepared, you might find out too late, when the payments stop, when the bills pile up, or when the tax office comes knocking. That's why it's more important than ever to stay informed, review your situation, and take action. Don't wait for a letter in the mail to tell you what's changed. Get ahead of it. Understand the rules, know your numbers, and if necessary, get advice from someone who can guide you through the details. Because when the rules change, the people who win are the ones who knew it was coming. And before you go, we'd love to hear from you. Which of these changes affects you the most? Let us know in the comments. We read every one. If you found this video helpful, please consider supporting our channel. We put a lot of time and effort into researching and creating content like this, and your one click to subscribe makes all the difference.